Inflation has arrived. Winter is coming was decried by characters in the Game of Thrones as they waited years repeating the phrase, winter is coming. It was ominous and infrequent, but when it arrived, it brought hardship and death, and maybe some also night walkers. For years, people in the real world, outside of these fictional characters, have been decrying the onset of inflation and how it's sure to arrive. In this video, I'm going to state it has arrived, and unfortunately, it's going to be bad. And some will suffer horribly while others might be able to minimize the effects, because nobody is immune to inflation. What is inflation, and why will it hurt, and who is there to protect us from this evil? In this video, Finance in 5, we will answer these questions and more, so stay tuned for the who, what, why, where, and how of inflation. Hello and welcome. I'm Ian Goldie, your host and educator. In the next 5 minutes, I'll provide a quick overview of this important subject. And those wanting to learn more, well, there's an extended version to this video. First, what is inflation and why should you care? Now, Wikipedia defines inflation as the general rise in the price level of an economy over a period of time. You and everyone you know should care about inflation, because this erosion of buying power simply means it costs more to purchase various goods and services. You don't earn more money, but it means your savings has less buying power. This is a bad math formula that nobody wants happening to them. When inflation gets out of control, you get hyperinflation, which in the past has crippled the economies of Austria, Bolivia, Brazil, China, France, Greece, Russia, Venezuela, Hungary, even North Korea was affected. One of the most visually striking images is Germany after World War II, where the government printed so much money that hyperinflation occurred and it took a wheelbarrow full of German marks to buy a loaf of bread. No funny jokes about Happy Meals. This is serious, and in some cases life and death when it affects food and medical supplies and other basic necessities for humans to live. Hyperinflation, brought about by government printing money, is called debasement of currency. We covered debasement on our video on cryptocurrency, but the simple answer is the increase of something as a base, be it gold or paper currency, becomes worth less because scarcity has decreased. What is happening now in the USA and many countries affecting inflation is the double whammy of printing money in huge quantities and the break of the supply chain from the COVID crisis. We have reached a tipping point on inflation, and in my opinion, it will be incredibly difficult to navigate for individuals, corporations, and governments. Along with my partner Adam Myers, we will use this video to also address what can be done by investors to prepare and mitigate this future environment for negative savings. Here is an app I like, not a sponsor. It's an inflation calculator. I was born in 1965, and $10,000 then had the same buying power today as $83,720. And the rise is the effect of inflation. See, in 1965, the minimum wage was $1.30 an hour, and inflation was running about 1.6% annually. And when you hear the term inflation rate, what that means is the annual loss of buying power, as we'll take that much more next year to buy the same stuff. And what is this stuff? It's based on CPI, or Consumer Price Index, which we'll cover soon. So the dollar you made for income back in 1965 was fine, as long as you could buy things of value. And you could, because a Ford Mustang was $2,368, and an average home was only about 20 grand. And an Ivy League education would cost from $1,700 to $1,760. You just had an increase. Students can't even pay for their parking for $1,700 annually, today's money. Wow, have times changed? And that is inflation and how it affects us all. According to the US government, inflation is currently at 4.2%. It was 1.25 in 2020 before COVID crisis. All the reported numbers are historical, based on what happened, not what is happening, nor what the future looks like. The government figures are based on looking through a rearview mirror, and most of us drive looking forward through the windshield. What was and what will be are monumentally different for forward-thinking investors. Now, Who does USA rely on to fight off the evils of inflation? Surely we need a superhero. We often hear the news talking about the Federal Reserve and their chairperson commenting on markets. I'm going to turn this over quickly to my partner, Adam Myers, who will explain the Fed roles in this entire process.
Thanks, Ian. This is a big subject that we'll cover more in the extended video, but the essential role of the U.S. Federal Reserve governors is to try and tame inflation. You can't defeat inflation like your Game of Thrones Nightwalker analogy earlier. So who are our superheroes to fight off the economic villain of inflation? It's this guy, Fed Chairman Jerome Powell. Before him was Janet Yellen, who took over from Ben Bernanke, who was passed the baton by 19-year veteran Alan Greenspan. Fed chairs don't do it alone. They have governors to help. I know you're probably thinking, these four don't look like they should be wearing a cape and a mask to fight for us. Surely they must have some super weapons at their disposal. They have three mighty tools to help fight inflation. The first one is two parts. They can raise or lower the rates the U.S. charges banks for overnight borrowing, and raise or lower the bank margin rate. A low margin requirement equals better loan ability for banks. Low overnight rates to banks is then passed along to businesses and consumers. Right now, rates are very low. Lower rates means less cost to borrow. Lower borrowing costs can ironically trigger inflation because people borrow to buy big ticket items like cars and boats and houses, which have all risen in price dramatically in recent years. Higher prices equals inflation, so you can see it's a delicate balance. Too little and you get economic instability, and too much and you can trigger inflation. The OMO, open market operations, allows the Fed to buy back bonds in the open market. Their purchases decrease supply, which stabilizes prices. In the past, this has been used primarily by buying treasury bonds, but during the 2007 subprime crisis, the Fed bought mortgage bonds, and during COVID crisis, the Fed declared they would buy everything from municipals to high-yield corporate bonds at a recent pace of $120 billion a month. When the Fed decreases buying, it's called tapering. Once again, too much too fast can create problems, that seesaw analogy described earlier. The Federal Reserve has another tool as well, and it's not printing money. That's created by Congress. The other mighty tool used by the Fed chairperson is words, specifically talking the market into believing what they see or what they are hoping to see to lull listeners into believing. Often this is the more powerful tool. This quick lesson on the Federal Reserve is done. I turn it back to you, Ian.
Okay, great. We are honored to help you with more information on inflation. Let's get right into the facts of how inflation is happening right now. These are forward projections, today's reality. Chlorine for pools has risen 65% last year because USA only had 3 manufacturing facilities and 1 in Louisiana burned down. This results in less supply. The COVID crisis, along with low interest rates, triggered a huge trend of building pools for those staying at home, and this creates more demand for chlorine. Now, professional pool cleaners are hoarding chlorine because, well, higher costs are bad. Not getting supply is even worse. We cover supply and demand in another video, as I believe every investor should understand the single most important fact of business. We cleverly titled this video, Supply and Demand. So, can't the pool buyer simply switch to non-chlorinated machines for the pool? Yes, they can. And they could, but demand has grown so much for this equipment that prices have skyrocketed there as well. This supply and demand imbalance has a ripple effect on inflation in multiple industries. Sticking with the theme of building homes, lumber has risen to astronomical heights with a recent 4-month increase, the highest in 70 years. This has caused the price of a building home to rise by an average of $36,000 increase. The copper found in the pipes and electrical wiring has gone up 100% in the last year. The talented people who have the skills needed to build a house are also in short supply, and new people can't be just taught something that takes years to learn in a few short months. So those with skills today command a higher wage because of supply and demand. Trees don't grow overnight into usable lumber, and chlorine factories don't get built in a week. Microchip factories can take up to 3 years to build, and these components are needed in computers. Yes, but they're also used in washers, dryers, refrigerators, microwaves, even blenders, shavers, and toothbrushes. Inflation is being greatly affected by how badly the supply chain is broken right now. For this, I'm going to turn it back to my partner, Adam Myers.
Thanks, Ian. Something made thousands of miles away still needs to be delivered. The initial shock of the COVID crisis shut down factories around the world because they had no workers. Manufacturing is returning, but the ability to deliver those items is not, because the backlog is still so great. You can't just build 20 new massive transport ships overnight. So what are companies doing to get finished goods? One way is to wait for extended periods of time, sometimes lasting months, for items to ship via ocean liner. Even this is not working well, because ports like the ones here in Long Beach that distribute most of America's imported goods don't have enough skilled workers to offload the full containers. Peloton, for example, did not want to lose clients waiting for delivery of their machines, so they made the incredibly hard decision to pay $100 million more in cost to bring their treadmills over via air transport. They got their machines in a few days, but at a huge extra cost, which they have passed along to their clients in the form of a higher price, which results in inflation. The microchip shortage you mentioned earlier, Ian, is partially due to one factory burning down, but it's also because demand has risen so high. Car manufacturers have shut down production lines because they can't get materials to complete a vehicle. That's right, the automotive industry, a backbone of the US economy, can't keep workers employed because of a lack of a component. Not because of a lack of demand, because right now demand is sky high thanks to low interest rates. As we were building our YouTube studio, we struggled getting computers and cameras and other necessary equipment, and what used to arrive next day with Amazon was taking weeks and costing more. Which reminds me, viewers, help us defer some of those higher costs by hitting the like and subscribe button. It's greatly appreciated. Ian, it's not just tech, building supplies, and labor where inflation is occurring, but also basics like food, where corn and others have increased by 50%. This will translate into higher costs for feedstock farmers use for cattle and chickens, which means you will pay more for your next meal. These are all real-world examples of inflation and how it trickles and moves into other markets. Before I turn it back to you, Ian, I would like to bring in another expert on this subject to explain how just-in-time manufacturing has added to this crisis for supplies.
Ian and Adam, I'm happy to share some of my knowledge on this subject. By way of background, for the last 20 years, I've worked various functions of supply chain, and I'm currently responsible for imports and vendor management at a major sporting goods company. Our business was greatly affected by COVID crisis, as the timing and disruption caused by international shortages in materials, equipment, and labor affected the ability to meet demand. So I am keenly aware, along with other operations professionals, how broken and disrupted the supply chain is currently. This broken status translates into higher costs for manufacturers and ultimately higher costs to the consumer. One major contributor to our current disruption was a manufacturing strategy invented by the Japanese in the early days of their automotive industry called just-in-time manufacturing. This innovative way of running a factory has now been implemented almost every major manufacturer around the world. Just-in-time manufacturing was pioneered by a country with no natural resources like rubber or steel to make their finished goods. The Japanese companies analyzed the situation and devised an optimal way to keep factories moving while reducing the costs associated with building large inventories. They developed very close relations with all their suppliers and shippers and other logistical components, allowing them to reduce inventory from months on hand to just a few short days. This process reduced the cost of buying and storing inventory, hence the name just-in-time. This has worked fine for decades, as logistics and efficiencies have only become better with the advent of computers. This COVID crisis highlighted the ugly side of just-in-time inventory. As with many other industries, evidence can be seen by the shortage we witnessed in medical supplies, for syringes, gloves, and masks, and also the most basic materials found in making drugs. Nobody wants higher costs, so manufacturers do whatever they can to lower costs so consumers can get the best possible product at the most attractive price point. We live in a global world, and I'm glad we are here explaining the important components found in supply chain and how it affects the cost consumers pay and ultimately how it contributes to inflation. I'll send it back to you, Ian.
I will use this as a segue into the future, because something that is broken does not stay that way forever. Right? We fix things, and everything will go back to normal, and inflation should go back down to where it was before COVID, from 4.2% today to, let's say, 1.2% pre-COVID. I don't agree with this thesis of going back to low inflation, which is what the Fed is trying to job out or talk the market into believing. Inflation is based on the Consumer Price Index, a sampling of 75 areas and 23,000 retail and service establishments around America. Examples of items to consider include food and beverage, housing, apparel, transportation, medical care, recreation, education, and some goods and services. And not included are people living in rural areas and farms. The CEO of publicly traded Energizer, symbol ENR, full disclosure on the stock as of this moment. The CEO said inflation is here to stay despite what the Fed wants you to believe. Cited for reasons were inflationary headwinds found in higher costs for commodities, transportation, labor, and tariffs. What are tariffs? And how do they affect the cost that leads to inflation? Now, tariffs were created by a government to tax the imports of certain goods. Bring them items into our country and we tax them. Now, the problem with tariffs is too large for this discussion on inflation, but a tax is a cost. And higher tariffs translate into consumers paying more. China, for example, charges Tesla a 25% import tariff. But for now, the Chinese do not mind paying, as Tesla sold almost 70,000 vehicles in the first quarter of 2021. But what happens when the rich do not want to pay that 25% fee and maybe consider another lower cost vehicle? In this case, a government has artificially affected the cost of the finished luxury good that people don't need. But what happens if tariffs are applied to wheat, oil, rare earth minerals, all other items of necessity? Then you get inflation that affects all. So, my thesis for higher inflation sticking around is based on a broken supply chain and tariffs. No, it's just not all of it, as the underlying issues go much deeper. Let me explain, then offer some investing suggestions to reduce the effect of inflation. The just-in-time manufacturing, explained prior, has been a large contributor to low inflation. And before COVID, I would have said that inflation looked tame. And I completely agreed with the Fed assessment. Now, several monumental items have changed in just the last year. The single biggest issue is our national debt. It's swollen to $28 trillion and projected to reach $50 trillion by year 2025. We'll cover this more in another video about debt, but for inflation, this means the Fed can't raise rates, they must keep rates low. Higher rates with this much debt makes paying interest on that huge sum even more impossible than it already was. We'll have low rates for a while unless the system collapses under the burden of all this debt. And rates, they will go wherever free markets take them. The Fed will have no control. In the video intro, I said inflation has the potential to get bad. So now that you have some more information on what is inflation, let me clarify my opinion. I don't think the supply chain will stay broken, and factory ships and other infrastructures needed to address imbalance will rebound and improve and help to keep inflation low, just like before COVID crisis. I do believe commodity prices will increase based on supply and demand, with the exception being if the world learns to recycle out and utilize what we have already dug up from the ground and processed. I believe wage inflation is going to increase, and the trickle down will be inflationary. Robotics and other non-human ways of addressing certain jobs will increase, putting more pressure on society's balance sheets to retrain or address lower wage workers displaced. In the short run, workers are the winners. But in the long run, I think those jobs will be disrupted by machines. Wage inflation is global and will be here for some time. The massive printing of government money will be short-term inflationary with winners and losers, but the massive balance sheet of national debt will contribute to what I see as a decoupling. That's a decoupling between the rate of inflation and the rate on bonds. Now, we have another video on bonds that every viewer should watch because I strongly believe you can't be a truly great investor until you understand debt and bonds. For illustrative purposes, let's look at this chart. Going back decades, inflation, or CPI, often moves independently of the Fed fund rate and the bond rates, but has consistently been lower than those others. The gap between inflation and bonds increased substantially in 1980 and started to close starting in 1990. The most interesting thing to notice, though, is how inflation has overtaken all other metrics in this chart recently, and this is the direction, I believe, it will continue to go. I have a strong opinion there will be parts of the CPI, like wages and commodities, that will continue to increase while bond rates stay relatively flat. Look, the only reasons why home mortgages right now are so low is because the Fed rate is low, plus the U.S. government is buying the debt. If buybacks are decreased or eliminated, then banks and other lenders will not risk capital losses for 30 years at a paltry 3% rate. Ask yourself, would you loan money to somebody for 30 years for a 3% rate? Of course you wouldn't. Home mortgages will increase. Corporate borrowing rates will increase, which will also contribute to inflation. We are raising the minimum wage, which is an immensely controversial subject. But from an economic perspective, you're paying people more. This higher cost is a major contributor to wage inflation. This is for basic jobs because advanced jobs are already paid more than minimum wage. And also, robots are already replacing humans in many areas of this type of work pool, from farming, cashiers, warehouse workers, etc. Those third world countries that make your iPhone and other widgets, well, some are not third world anymore, and they want higher wages and have been getting it. When a worker receives a wage, two things happen. One, the worker pays taxes and other costs and does not keep all the gross wages, and the employer pays a lot more in costs than what the stated wage is. Example, a $15 an hour employee might keep $13 an hour after taxes. Now, most employees don't know this, but the employer must also match the taxes paid by the worker, plus many other costs. The Small Business Administration says employers should estimate 1.2 to 1.4 more times in costs per wage hour. Therefore, a $15 an hour worker should cost an employer up to $21 an hour, based on the SBA. But this is not entirely accurate for those employers offering healthcare coverage, which can easily add $1 to $2 per hour. Or what about companies offering a 401k plan or other retirement plan? Or how about training costs and extra sick days? A $15 an hour employee can easily cost $22 to $25 an hour, or about $50,000 a year for a minimum wage job. Higher wages leads to higher finished goods, which leads to inflation. Now, there's also more humans in the world today than there were 20 years ago, and I am betting in 20 years there'll be even more than today. This growth of consumers puts pressure on available resources. The world doesn't have unlimited supplies of oil, lithium, latex, food, etc., etc., etc. A finite supply of anything equals scarcity. In our video for supply and demand, we explain that this is almost results in higher prices. So, what can be done as an investor to reduce the negative effects of inflation? Here's some ideas. Invest in companies that have pricing power and elasticity. Companies with pricing power and elasticity often fit into the category of items people need versus what people want. If you need gasoline in your car to get to work, then you will pay whatever the price is because you can't make your own gasoline and walking or public transportation might not be available. When gas prices do rise, people look for alternative forms of transportation. So this can affect demand, but maybe not really pricing. If you need a drug to stay healthy or alive, then you need to pay whatever they charge and you really can't cut back or alter your purchase. A luxury item will still sell at a high price because ultra wealth does not get affected by inflation. But the masses that do buy the luxury brand, they will scale back their purchases. So, besides the energy and drug sector, what other sectors look attractive? Cellular communications has now become an indispensable part of humans' life. Now, the pricing elasticity of these companies is kept in check by the competitive nature of some of these other companies, their competition. But there's only so many providers in each area of the world, and this limited competition and very high barriers to entry, I think, provide a good investment as a hedge against inflation. Utility companies providing water and electricity is another sector to consider. Gold has been considered for decades a good hedge against inflation. But that's not statistically true, and the recent addition of cryptocurrency has given investors an alternative to the shiny gold stuff. Other sectors to invest in an inflationary world include healthcare, specifically need products and services like drugs, devices, and patient care. Another sector for inflationary fighting or any market condition is technology that makes a company or individual more efficient. These companies might have some growth hindered by inflation, but the demand remained if they can offer a solution that saves people time and money. All humans need to eat, and many don't prepare their own meals, which creates opportunities for companies like Chipotle. But how many people are willing to pay $20 for a burrito? No matter how delicious and healthy that meal might be, the company can only charge so much for the finished product before there are no buyers left for what they have to sell. This is an example of how far pricing elasticity can stretch before it breaks. But the ingredients found in the burrito would be a good place to invest, as people still need to eat. So look at the grocery store aisle for investing ideas. Before COVID, I would have said the movie industry was a good defensible place to invest. But that industry now has too many problems affecting their pricing power. We still enjoy entertainment, so I believe this industry in the form of streaming provides a good place to invest. But the issue of advertising revenue will affect their net profitability in an inflationary world of the future. Now, people also need a place to live. So rental housing for humans, not corporations like real estate, that looks like an attractive sector in a higher inflation world. Finally, I like the sin stocks. Now, these are companies found in making humans feel good. They might not be the healthiest of choices, typically smoking and drinking. This too has changed with marijuana reform laws, creating more companies to invest in. At Finance in 5, we will have periodic updates to inflation in our weekly or monthly summaries. So if you like what we have to say and how we say it, then hit the notification button and you will get our updates as they occur. While you're there, also hit the like and subscribe button, because that helps us make more of these educational videos. I'm Ian Goldie. On behalf of myself and my partner Adam Myers and our special guest, we thank you for your expertise and all of our viewers for staying tuned in Finance in 5.